Welcome to a comprehensive overview of business valuation approaches and methods, designed for finance professionals and students alike. This presentation will guide you through the essential techniques used to assess the value of businesses in various contexts. In this module, we will delve into the definitions of value, explore different approaches to valuation including market, income, and cost methods, and examine specific techniques within each approach. Additionally, we'll discuss practical applications, helping you choose the right approach and avoid common pitfalls. Understanding the different ways to define value is crucial. We'll explore fair value, which is the price in an orderly transaction between market participants. Market value is the most probable price in a competitive market. Book value is recorded on the balance sheet, and liquidation value, which is the amount from selling assets separately. Valuation relies on key assumptions that shape the outcome. These include the going concern assumption, where the business continues normally, orderly transaction, which allows time to find the optimal buyer, forced sale under distress conditions, and liquidation, which considers winding up value. Let's explore the three primary approaches to valuation. The market approach, which is based on comparable transactions, the income approach, which focuses on future earnings, and the cost approach, which considers replacement value. Each approach offers unique insights into business valuation. The market approach involves using multiples from listed firms, analyzing comparable transactions based on recent deal prices, and considering direct exchange prices. This approach provides a real-world perspective on business valuation by leveraging market data. The Guideline public company method involves identifying comparables by finding similar listed companies, calculating multiples such as P/A, EV, EBITDA, and P/B ratios, making necessary adjustments for size, growth, and risk differences, and applying these adjusted multiples to the subject company. The comparable transaction method requires identifying recent M&A deals within the same industry, extracting pricing multiples like EV, EBITDA and EV, revenue, adjusting for differences such as control premiums, synergies, and timing, and applying these metrics to the target company. The market price method is best used for publicly traded companies in an active, liquid market with no manipulation concerns and recent relevant trading. Necessary adjustments include control premium, marketability discount, blockage discount, and considerations for extraordinary events. The income approach is future-focused, based on expected cash flows or earnings, and accounts for the time value of money, considering risk and timing. Key methods include discounted cash flow, DCF, and capitalization of earnings, providing a forward-looking perspective on valuation. The discounted cash flow method involves projecting cash flows over 5-10 years, determining the discount rate by calculating the weighted average cost of capital, WACC, estimating terminal value through perpetuity or exit multiple, and calculating present value by summing discounted components. The capitalization of earnings method uses the formula value equals earnings divided by cap rate, making it ideal for mature, stable businesses. The cap rate reflects discount rate minus growth, and the earnings basis is normalized, sustainable earnings, providing a stable valuation framework. The cost approach considers replacement cost, reproduction cost, and the adjusted net asset method. Replacement cost is the cost to replace with equivalent utility, reproduction cost is the cost to create an exact replica, and the adjusted net asset method calculates the fair value of assets minus liabilities. The adjusted net asset method involves restating assets to market value, adjusting liabilities to include all obligations, adding intangibles to include off-balance sheet value, and calculating net assets minus liabilities, providing a comprehensive view of a company's net worth. Choosing the right valuation approach depends on asset characteristics, data availability, and valuation purpose. Consider whether the company is operating or holding, asset-heavy or service-based, and mature or in growth stage. Reliable forecasts, comparable companies, and transaction history are key factors. Reconciling valuation methods involves considering weighing factors such as reliability of inputs, appropriateness for asset, quality of comparables, and forecast credibility. Example weights for a mature operating business might include DCF at 50%, GPCM at 30%, CTM at 20%, and NAV at 0%. Common valuation multiples vary across industries such as technology, healthcare, financial, retail, and utilities. Understanding these multiples, including P/A ratio, EV/EBITDA, and P/B ratio, helps in comparing and contrasting businesses within different sectors. Valuation requires precision and careful analysis. Common mistakes include forecast error, comp selection, discount rate miscalculation, and adjustment oversight. Avoiding these errors involves thorough documentation, review, and analysis to ensure accurate and reliable valuation outcomes. Clear documentation builds credibility and defends conclusions when challenged. Include an executive summary, assumption documentation, methodology justification, and source attribution. Detailed records ensure that another qualified valuator can replicate your work and reach similar conclusions. Successful valuation professionals develop essential components to strengthen their expertise and deliver accurate valuations. Continuous learning, peer discussion, certification, and technology proficiency are key elements. Combining these enables professionals to handle complex valuation challenges with confidence and precision.